Good afternoon and welcome to our webinar, Zimbabwe Playing Catch-Up. Today's episode is the first in a series of preview country-focused webinars leading up to the API Summit virtual event, which will be taking place online between the 28th of September and the 2nd of October. These preview webinars will be focusing on Botswana, Zambia, Mozambique, as well as the Francophone region. So please look out for our emails and social media for more information regarding dates and times. We'll be running these all the way up to the week of the 28th. So stay in touch and stay in the loop in regards to the dates and times for those sessions. As mentioned, we'll be hosting the API Summit this year virtually between the 28th of September and the 2nd of October. We already have over 40 leading speakers confirmed, and we'll be releasing the agenda next week. We've got some very interesting sessions and brilliant presentations all lined up for that week. Attendees will also be able to gain access to all the sessions, both live and on demand during that week, as well as being able to view all attendees and the attendee directories and using that to set up virtual meetings during that week, both with colleagues, with people across the continent and globally. So there'll obviously be the session element as well as the networking element and virtual booths as well. The week will also include the 4th edition of our API Awards, as well as the Africa PropTech Forum. So it'll be 5 days of sessions, networking, and all different elements in regards to the different sectors, countries, regions, and topics within African real estate. So for more details on that, once again, we'll be in touch via email, but you can also visit our website, our API Summit website, where you can register, view the speakers, view the program, and take away any other details needed there. So for today's session and episode, I would like to welcome our moderator, who's Kura Chihota, General Manager, CBRE Accelerate. He'll start off with providing a brief presentation on the current state of the Zimbabwean real estate market, and then introduce the panel for today. We very much look forward to this discussion. So thank you all for joining us. And Kura, I'll hand it over to you now for the presentation, and then we can move on to the session. Thank you.
Welcome to this virtual seminar. It's good to be in touch with you wherever you are, whatever you're doing, that as professionals we can get to meet and share ideas and enlighten one another. It's good to have such an incredible panel. The energy was made on this presentation. By the time we got the lineup here, I hear that registrations shot through the roof. We have Jeremy Brook, the Executive Chairman of the Cardinal Group, a leading developer in Zimbabwe, fantastic product all over. We stay safe with Lloyd Manokore. He is the Managing Partner of DLA Piper, Manokore Attorneys. He keeps us within the legal limits and keeps it together. And then we have a man with a almost unlimited checkbook, Mr. Washington Moyo. He's head of corporate finance at NBS, National Building Society, a 100% subsidiary of the National Social Security Authority. So we have the doer, the regulator, and the financer in the house. So we look forward to making this session as interactive as possible, that we are enlightening one another, and we are collegial. The question and answer session is running live. I understand Priscilla is going to be taking questions, and at any time, please don't assume any of our speakers are dark forces. Please speak your mind and let us enlighten one another. So I was scratching around, putting together some information to say, how do we start the conversation? Our South African counterparts put the question, Zimbabwe playing catch up. If you're watching from outside of Zimbabwe, the ongoing social media battle, when the Zimbabwe Lives Matter was raised, I got 3-4 SMSs. Are you guys okay in Zimbabwe? Let's take you through what is going on economically on the ground. We have an economy, we have a government, we have commercial systems, and we are doing what we can to survive. So let's get a bit of context in what's going on in the property space. Well, I was asked to moderate the panel. So to moderate the panel, let's do the first thing. can we talk? Let's go to the thesis, the matter that's been put before us. Zimbabwe playing catch up. Are we lagging behind? If so, where, why, how, and what implications does that have for us? I want to give you a bit of an insight into what is happening on the ground in the property space. Then we can look at what is I think the elephant in the room, our inflation and currency, then throwing up distortions, and the fact that our asset class called real estate is being made to do a whole lot of other functions than is typically made to do elsewhere in the continent. But then we're going to moderate that with practical, real, what has happened on the ground. We are not and I don't mean it disparagingly, we're not a Mogadishu or a Juba. We are a established property market with norms and practices, deeds offices, rates, bills, and all of the good stuff that you can imagine. So let's go through this together. Drawing on a great regional comparison, the Knight Frank report, it stacks up that our rentals are softer in the US dollar. I will always keep on referring back to this funny thing called the Zimbabwean US dollar. We seem to price it differently, but objectively, if you compare us to our peers, you can call two of them peers, Lusaka and Gaborone. We are similar sized economies, plus minus 20 billion US dollars each. So you would expect some sort of similarity, but we can't compare ourselves with the mighty behemoth in the region being South Africa with a 300 plus billion US dollar economy. So our rentals lag. We are behind in prime office rents. We have some superb product. We have world-class parks. One of them happens to be modeled along the lines of Harrow-Dean in Johannesburg, occupied largely by the UN, by one of our listed companies, First Mutual Properties. You can take that as a proxy as the best in the market, the P grade kind of stuff that South African SAPOA ranking knows and understands. We talk about our retail. Retail, we have the latest product that was developed and delivered by Terrace Africa, Village Walk. Village Walk, if you close your eyes on a Saturday morning, you could be confused that you're woken up in the middle of Morningside Sandton. You have your Pick and Pay to your left. You have your Apple store to your right. You can go buy a burger at Rockamama's. So international brands operating and trading in the market quite comfortably. Our industrial stock, Zimbabwe is a funny little beast. We grew up under sanctions with the previous regime. We've been under sanctions with the current regime. So our industrial stock, I think, was artificially stimulated, and it lags somewhat. Our product is old sawtooth design, low eaves height, no dock level loading. So our industrial product is behind, and I'd attribute that reflecting into the number that we are behind on rentals regionally. Our market is in hyperinflation. Since 2018, we crossed over the 100% inflation mark, and that was compounded with a regulation in currency that you could only transact in local currency. You were criminalized from setting your prices and or receiving US dollars, as had been the case for pretty much 8 years prior to that. So what this does is then throws a pricing discovery issue into the market. That what is a Zimbabwe dollar worth? We have an official exchange rate, which has reduced in volatility by being quoted on a weekly auction basis with the Reserve Bank. But there is a parallel market rate where individuals who have not come through the confines of the system, declaring their earnings, putting them into formal banking facilities here in Zimbabwe, do trade the currency. So inflation throws what is a dollar worth. So I can get a US dollar invoice for rental from my landlord. I could settle it in US dollar cash, or I could get Nostro, which is an internal arrangement with US dollars where you're trading amongst the banks and the settlement that way. Or there's the third alternative of being paid externally. Now, I'm not condoning any of those methods, but the reality is the US dollar does not have a fixed price within the market. So what that throws up is people then either inflating the US dollar price nominally to get the official rate so that they can do official transactions, but you can understand the distortions that pull through with that. With that, asset pricing becomes difficult because valuers have to look at written lease agreements to derive values, apply cap rates, and then we put that into, particularly in the listed environment, you run it through the accounting standard IS 29, and we now get a complication within a complication. What's the base number? What is it really? Does it reflect reality? Because of this uncertainty, real estate, because of its classic attributes being a store of value, being something of tangible nature, being something that is enduring, being something that can reprice, we have had an attraction of capital into the real estate sector. This is the best view of institutional property investment in real estate. We have the Insurance Pensions Commissioner. They review all of the assets held from a regulatory perspective by the pension funds and the insurers, and they collate that. So the trend has been that the valuations have risen, as well as you can look inside there with the asset allocation that we have real estate outperforming equities. I think this is a trend that's going to further accelerate with our stock market becoming even more illiquid. We've had this position where the largest most liquid, English bundles are running out there. Most liquid counters have been frozen out of the market. So you now have a shallower, thinner, narrower stock market. And we expect when somebody's trying to retain value, when premiums are received by an insurer or life insurer, they want to put that somewhere. And one of the assets available would be real estate. So a sub-market snapshot, just in synopsis, we've got a bull, a bear, and an avoid. Offices I don't know how many of my colleagues are not operating from the office. We have significant question marks around the pricing of offices, the need for offices, how we're reorganizing, how do we socially distance, how do we get back safely into the work environment. So the product is moving along with that. The CBDs have become increasingly unattractive investments. They have political uncertainty or political unrest or close downs or shutdowns. There are power issues. The pricing of parking and the inconvenience of running over your time with parking is a significant nuisance factor. And if you take Harare, for example, you see that along the Sam Nujoma arterial road leading out of town, you have developers taking up the gap and creating a more pleasant, low-rise office environment. Further north, we've got developments, Borodale Racecourse are going to come up. I know Cardinal has some land out in that direction. They will be looking to do something on a commercial basis there. We have landlords under pressure. They don't have the pricing leverage that they used to. So when rentals come to an end, the negotiation is swift between the tenant and the landlord, and more likely than not, the landlord is going to try and retain that tenant because they know replacing them is going to be difficult. Retail, I'm bullish on because the win-win situation has been created between landlords and their tenants, where there's a turnover rental. That turnover rental is very helpful in this hyperinflationary period. You've got longer leases, but with the ability to reprice because of inflation, the landlord is seeing some upside. The listed landlords are typically taking a quarterly review on their rentals, but with the retailers on a monthly, because of the cash flow, you can get your turnover rentals a lot quicker, and that is minimizing the value loss between once you've signed the lease and receiving the money. We see some growth in the bottom end of the pyramid. The cash and carry market has expanded and it has moved out of town. It's going into smaller areas, and those smaller areas are gratefully receiving it. You've reduced transport costs by putting a mega save out in a small town like Mvurwi. You're taking convenience to your clients. Industrial, as I said earlier, old stock is functionally obsolete and underutilized. Our capacity utilization on the industrial space is less than 40%. There are pockets of high demand. Seasonally, you'll find high roof tobacco warehousing space for traders, people moving stuff in and out, looking for warehousing premises. You do get inquiries for between 5,000 and 3,000 square meters of decent space that people can move. Some you need to move with a forklift. I suspect there's some COVID tenders and PPEs being stored inside there, but there's a nice uptick for quality, well-located industrial. So it's a green shoots. I can tell you that we have an economy. I can tell you that the economy is looking at shrinking by 15% at least, that the effect of COVID, we haven't had the stateside supply or assistance with impact relief. We have we did operate for 2 months under a statutory instrument where residential mortgages and residential leases, there was a moratorium on making payments. The amounts were never forgiven. They were just deferred to a later date after the lockdown period. We're still to recover from that. But on the ground, we have new office blocks. The first one, Belgravia offices, that's one of our clients' properties along Sam Nujoma. We're leasing there. We have a transaction under negotiation. It's a suburban office block, parking out front, branding opportunities, easy access from north, south, east, west. The second picture is the big box retailer along Seke Road. So that's the main southern arterial going to, they call it a dormitory town. It's a more residential, less industrialized township, if we to use that parlance. And then on the right, we have the new generation Pick n Pay that's opened up in Aspendale Park. Again, the quality has moved up. If you go into that Pick n Pay, it's a step forward from what has been township retail. We do have other retailers with township locations, but this has definitely stepped the game right up. We could do a whole webinar on the social media trends arguing about is Zimbabwean residential real estate overpriced? The best empirical data to keep it safe and keep it tidy is I went on to property.co.zw, and they have a portal where they offer advertised properties. So this is not something like the South African Lightstone or SAPTG, where it is deeds office data. This is properties on offer, and the trends that they've shown there, the trend, and I'm going to leave it as the trend so that I'm not leaving myself open to abuse, that I've said property prices are falling. Well, the trend is that the properties that are advertised there are falling. And that has been a trend for the past 9 months, if I've got the scale right. What's happening in the supply side? You look at the property market and the residential, what are the drivers? At a retail level, do we have the money to invest in real estate? Mortgages have somewhat dried up. Washington is going to take us through the trends there. But we see our the inputs, PPC, their volumes are down between 15 and 20%. Lafarge Cement, volumes declined 30%. Wheeldale Bricks have reported a 62% drop in volumes. So I would imagine that being economic and rational people, if volumes are going down, it's explaining something broader happening in the market. But there will always be a fly in the ointment. Turnover, which provides a lot of building materials, their turnover is up 45%. Make of that what you will. So it's a great pleasure to join the rest of the team here. It's good that CBRE Accelerate is back with a bang in the country. We're here to do the typical property services, valuations, developments, capital markets, and advisory. I have my details there. I look forward to being in touch with you. But let us get right on to the story and the debate. I'm going to go through the panelists and ask them for their opening statements, their opening feelings, and then I have a set of logical questions to take the panel through. So thank you for your time, and let's kick off. I'm going to call upon Jeremy Brook. I've got Lloyd already up here, so let's go with Lloyd. Lloyd Manokore. Okay, you're just entering one by one. Okay. Jeremy, you are the author of, I think I've circulated it and I've got more social media traction on the 1,000 kilometer difference, the presentation that you did at Zimreal. So you have great notoriety in that. But you are boots on the ground, significant landed position, significant work in progress. How are you finding the real estate market in Zimbabwe currently? I think you're muted, sir.
Thanks very much to all the viewers, and Kura, thanks for hosting. The situation on the ground is not easy, and it's probably because a healthy and robust property sector represents a balanced economy and a healthy, robust economy. And right now, Zimbabwe is not. We are having difficulties, and it reflects directly in the sector. So yeah, as we stand right now, we're having a tough ride.
Thank you very much. Lloyd Manokore, you got queues outside your door where people are fighting over leases, interpretations of this SI, trying to get out of deals that were struck in 1-to-1, but then trying to be enforced in this environment. How are you finding the practice of law, real estate law, here in Zimbabwe in this environment?
Thank you, Kura, and thanks to API for inviting us to participate on this webinar and an opportunity to share perspectives. I just looked outside the window and the queues are not quite there. But the reality is certainly there is a lot of concerns by landowners or landlords around their portfolio mix, performance of those portfolios, and as to whether how to handle defaults, how to protect themselves in the short term, as well as the medium term. Interestingly, the inquiries are more around how do we rebalance, how do we repurpose our portfolios without jumping out of the plane and giving up, because as you indicated in your opening remarks, property continues to be a definitive store of value, and one is seeking to make more reasoned or more pragmatic decisions on what to do with that portfolio. But echoing what Jeremy was saying, there are a lot of people sitting on the edge of their seats and looking for solutions. So we're helping in those conversations.
Thank you very much. Washington, I must say to you, you are my landlord. You hold the mortgage over the roof over my head currently. NBS Building Society, you're in the finance game. Can it be easy when you issued me a mortgage in US dollars and I'm now paying you back RTGS at 1-to-1? Talk to me about the logic and the sustainability of the finance or property finance in Zimbabwe currently. I'm battling to hear you, Washington. I'm not sure if you're unmuted.
Oh, sorry for that. Yeah, I was muted. So thanks, Kura. We find ourselves in an interesting environment where, as financiers, obviously, what we are getting in terms of returns for what we issued to the borrowers is not in line with the expectations, but we just take it as a reflection of how the economy at times moves in cycles. At times you lose, but at times you also win.
Okay, so you're playing the long game. I guess being funded by a pension fund, you can take that patience. If I was a depositor and I put my money in the bank, I would be looking for a very short return. I would have given you my capital and be looking for a shorter return. Jeremy, we often hear this often said statement, oh, there's such a huge housing backlog in Zimbabwe. We should be able to push out houses. You are trying. You have specialized in, can I argue, a bit the high end of the market. I know in Arlington, you've got some of the smaller stands, the Sunbird Villas and what have you. But what is the domestic household situation and appetite for functioning real estate before we've gone into the institutional kind of demand for the Zimbabwean? Where are they? Are they earning enough to buy or to aspire to buy a residential property?
I think when you talk Zimbabweans, we have to talk two kinds of Zimbabweans. The one is the person who works in Zimbabwe and who receives a Zimbabwe dollar salary. And the other is a Zimbabwean who lives abroad and works abroad and has ambition to own a property or a stand in Zimbabwe. So the Zimbabwean market has been decimated. The salaries have lagged hugely, and quite frankly, in 800 to 900% inflation, nobody can catch up.
Sure.
The demand from external is very, very strong and is getting stronger. COVID has introduced a greater degree of saving and a greater demand for people wanting to secure a property back home. So the answer is demand is very strong from Zimbabweans abroad, not strong from Zimbabweans here, but desire to buy, underlying, it's huge.
Thank you. That gives me a nice segue. NBS has tried something innovative. You've offered local mortgages. I'm a beneficiary of one. I do know that you've gone with an innovative product. You've got some diaspora stands that you're specifically targeting for those outside of Zimbabwe. How did you get to see that as the opportunity that I don't think many peers have actually gone and registered diaspora product like that, Washington?
Thanks, Kura. So you would know that besides the diaspora product, we are still playing in the mortgages market, and we are indeed offering a full package in terms of housing finance solutions, but we do have to respond to market realities and package products which will give us the returns which are commensurate with the expectations of the financing arrangements which are in place. And how we do it in terms of repackaging our product portfolio in the housing finance space. For now, we have looked at, I think, three aspects which, in our view, affects returns, rather two aspects. The first one is currency, as you mentioned. So the reason why you see the diaspora product gaining more prominence at this stage of the economic cycle is that we believe that's where we can generate real returns which are commensurate with the expectations of the financing arrangements. But in addition to that, you would also note that we also do have other financing arrangements, maybe where someone is comfortable to give us a deposit on a short-term basis. And we are also matching that with the loan products or mortgage products that we are creating, which in this case, it's a micro mortgage, where instead of giving a mortgage with a tenure of 20 years, we have shortened the tenure to a tenure which is short-term and in line with the funding arrangements which are in place. And then lastly, we also find ourselves in a situation where we do have other opportunities where we can arrange funds from specialized structures where the financier also has clients who want to access mortgage products for the funds that they're providing. So on a matched basis, we can actually issue normal mortgage arrangements with a normal tenure of 20 years or whatever tenure which is in line with the ultimate financier. And in addition, we can also issue mortgages in local currency, but in line with the financing arrangements.
Thank you. Lloyd, a bugbear of mine is these funny title arrangements that we do in this country. Session ready to build, offer letter, and any hybrid thereof, parent deed awaiting X, Y, and Z. How do we stack up regionally in terms of our property or land registry and the processes that secure when I've put my dollar and I've got real title in a real asset? How are you ranking us against our peers in that?
Thanks, Kura. I think perhaps I'll start off with just a bit of an anecdote. Speaking to a friend who's an ambassador from one of the Western countries a year or so ago, and we're just basically discussing around Zimbabwe, doing business in Zimbabwe, and so forth, and of course the rule of law, as is often thrown around on social media or in other media platforms. And as we're engaging in this sort of backwards and forwards banter, he ultimately said, well, I assume that if there was no rule of law in Zimbabwe, you would be out of business. You wouldn't have anything to do because as lawyers, our frame of reference is law. That's why we come to work on a day-to-day basis. And that's what we engage with our clients about, and helping clients navigate the regulatory framework that exists. And ensuring that there is compliance. So be they developers, purchasers, sellers, the starting point is what do the rules say around the passing of property from one party to the next. I think we compare favorably with other jurisdictions. In the conversations that we have, as you know, we are part of a 20 odd in terms of numbers of jurisdictions network, and we engage regularly with colleagues from the different regions of the African continent, and just to help understand what's going on in their jurisdictions. And I think Zimbabwe compares favorably on the basis that our land system is fully defined, surveyed, titled. Traditionally, Zimbabwe is operated on a title system, freehold. And that land can either be owned by an individual, it can be owned by a corporate, it can be owned by government, or it can be reposited to the custody of a traditional leader in the form of communal lands. But it's not one of those situations where you just go and you put a stake in the ground and now it belongs to you because you're the first to put a stake in the ground. There are rules. And you're quite right in raising your bugbear. Whenever you've got a regulated system, the question to be asked is it efficient? Is it working at the pace at which the macroeconomy is working? And I think that's where the disconnect and the frustrations arise. The speed at which you get information about a piece of land, where that information is reposited. Should be at a click of a button, or do you have to physically get into an office and page through a whole host of physical documents? These are all issues that are real and are a fact of how we operate in Zimbabwe. But we have a Surveyor General, we have a Registrar of Deeds, we have local authorities, and these are all parties that play a part in property and land development or property purchase or disposals, and you can't wish them away. And I guess what we are observing now is the transition where the policy pundits are in the process of looking at how to regulate and come up with regulations that make it easier for these activities to happen. I know for a developer like Jeremy, cost and time is everything. As the good old saying goes, time kills all deals. And that is a big concern for our developer clients. It's also a big concern for our clients who are seeking to have a piece of paper in hand. After I've paid for my purchase, when do I get my title? How long will it take? And as you may know, Kura, you've got to involve the local authority, you've got to involve registrar of deeds, you've got to involve the tax authorities and navigating those. But I guess what I'm referencing and just going on about is that there is a defined system and channel in which you have to operate.
Sure. Jeremy, on the currency issue, for us as investors, and a lot of my peers have one leg in, one leg out. They're in diaspora, exactly as you've described, that people are sending money home. Has the RTGS issue, RTS to dollar issue, has that helped you or has that hurt you? Has that created a great demand? So we're trying to convert whatever RTGS I get paid, I quickly try and want to put it into an asset that can become a US dollar asset when I sell it. Is that driving you, or is it hurting you in terms of your procurement? Could you do more if we had a stabler currency?
Kura, anybody who's lived in Zimbabwe and been through devaluation knows that there are short-term windfalls to be gained from the currency devaluing. Yes, for 2 or 3 months, the employees get less. And there were times, and there are times, when developers can make quite a lot of money on the back of devaluation. But devaluation and inflation is a catastrophe for property. It's almost the worst thing that can happen, because the chain has to work. The chain is balanced from the employee who gets paid a salary, who pays a mortgage, who in turn repays a bank, and the bank funds a developer, and a developer buys a piece of land. That's a naturally balanced, market-driven chain. That's what we need. What we've got now is, with the devaluation, we've completely wiped out the working capital. I don't think the banking sector here has got more than $40 million in it, in hard dollars. It might say it's 180 or 200 million, but 3 years ago it was 4 billion. So right now you cannot borrow money to develop. It's not available. It's simply not available. So when we wipe out the working capital, it completely eradicates any small-term gains that come from the lead and lag of inflation. It's not good for us. We want to get to a stable currency as quickly as we can to enable people to get a fair salary and pay their mortgages.
Thank you. I've got a couple of questions through from Priscilla running things in the background there. Question to Washington. Washington, how do you keep track of sustained asset real value when inflation is running at astronomical levels? Mathematically, my mortgage with you guys, 40% interest rate, annual inflation, 900%. I'm laughing all the way to the bank. How do you as a business make sense of that and come out ahead?
So surely with that scenario where inflation is way above the interest rates, you will get negative real returns. But what banks are now looking at is to obviously find ways of preserving value for both depositors' funds as well as their retained earnings. And that is being done through various means. And key to that is that they are playing with the nature of the products that they are creating or serving to the market, either by remodeling existing products or creating new products. In terms of remodeling, as I said earlier, you can look at maybe instances where banks are changing the tenure of the loan products to ensure that they retain some flexibility of either repricing their loans in terms of interest rates. That is, if there is that scope to review the rates upwards. And it also gives them flexibility, or rather an opportunity to roll over into other high-yielding assets instead of remaining invested in a loan product for too long where the returns are subnormal. So in addition to remodeling the nature of the products, you also look at the asset side. Banks are on a drive to acquire real assets, which they can use as a store of value. I think if you look at the balance sheets for most banks from say 2015 up to now, there has been a reasonable growth in terms of either investment property or property and equipment, which is a reflection of the acquisitions of the assets that they are acquiring.
Which is another direction for us to talk about Basel, about banks making money out of being banks or by being transacting agents. Non-interest revenue for you guys is now more than doing the business of being a banker. Jeremy, you wanted to say something there?
A bank's job is not to go and mop up the property in the market. The bank's job is to provide banking services to those who fulfill the roles. Now, when you get to a situation where the bank takes all its liquid cash, goes and buys a property, and then warehouses it in the pension fund or in some other SPV, we stop liquidity. When we stop liquidity, we stop trade.
Indeed, indeed. Right, I've got a general question here, and I read it verbatim. In light of the flip-flops of the fiscal and monetary policies, developers are delaying sales of service stands or houses, fearing to incur currency-induced loss. What is the best way to boost both the supply and the demand for housing?
Can I go with a bit of a technical one? I know we're quite tight on time.
Sure.
If you sell a property today in US dollars, the revenue is 100,000 US dollars times whatever the exchange rate is. Call it 80. So that's $8 million of turnover. The cost of sales that was incurred 3 years ago in US dollars is booked at 1-to-1. Consequently, you will pay around 14% VAT and around 28-29% income tax. So property developers do not want to sell now unless they can replace the stock instantly. So in answer to the first part of your question, is stock remaining unsold? Yes. And the only way it can be solved is when the tax calculation allows a developer to book the cost of sales and the cost of the property and the cost of improvements at a fair exchange rate.
Thank you for that. A general question.
Kura, could I just maybe add to that and just say the beauty of this asset class and property is we tend to refer to as the good or the great equalizer. There's nothing more real to what has just been enunciated by Jeremy and also what Washington was referring to earlier on. You cannot fudge the numbers. And to an extent, I actually like and I enjoy the real estate sector because to an extent it forces reality in discussions because it affects every single one of us, the haves and the have-nots. And to an extent, when those economic fundamentals boomerang back and manifest themselves in the way that they do, we are finding that policy promulgators then get to respond because that's as real as it gets. It's not intangible. So yes, there could be, as the question says, referencing the policy flip-flopping, but economic fundamentals are fantastic. They're no more realistic than they are. That's what it is. 1 and 1 adds to 2. It can't be anything else.
Thank you. Cracking on with the questions for those who are tuning in to us. It's a general question. For residential properties, is it currently cheaper to buy or build? i.e., do prices reflect the replacement costs?
in certain areas, it's cheaper to buy. So in the iconic areas, the more top end areas, sorry, it's cheaper to build in the top end areas, and they are moving away. There's quite a big separation between the marginal areas and the very good areas. So in the good areas, it's much cheaper to build. In the lower areas, it's probably cheaper to buy at the moment.
All right. So are we now getting true real estate economics where an address number 23 Orange Grove Drive has cachet and it's got imported materials. So to replace those, you've got there's a premium on that. Are we talking to that? Washington, how are you seeing applications for complete properties versus building loans?
So in terms of applications, obviously it talks to the nature of the products that we are offering. For the diaspora mortgages, for now, from our end, it's mainly stands. I think which talks to the desire by the clients to build houses to their own character and their own preferences, rather than buying a house which is already built and with the character or design which is not in line with their taste. So from the diaspora, the interest is mainly on the states. Locally, obviously, it's widespread depending on the specific opportunity that one has, given the limited supply of houses which are on the market for sale, especially in the local currency.
Okay, I've got two questions directed at me. It says, what are the ranges landlords are conceding in office rental market due to COVID? You're welcome to come to my office and I can consult to you on that. But in general, look, it's a win-win, and I genuinely. So we look after over 200 tenants. The conversation is monthly. We have to, as landlords and tenants, have an open book. The methodology that we use is we look at when things were good. Call it a 2017, whatever peg in the sand you want to put it. We say, what were you paying in US dollars? What was your turnover in US dollars? What did your business look like? Then we'll make an arrangement to say, okay, we discount what was a hard US dollar price and say, look, at parallel rate or at auction rate, this is the number. Does this sustain your business? So we will never take an equity position in your business, but we have vested interest to see that you're doing okay. So the concession that we would give would be temporary, to say, look, this is to assist you with cash flow, to keep the operations, the doors open, the lights on, because we don't want to lose you as a tenant and then have to go through yet another fit out. So it's on a case-by-case basis, but you can look in anywhere from 20, 30, 40% discount on a hard US dollar price, what it was in about 2017, 2018, and then you'd reprice that into local currency at the auction rate. A further question on general, what is your view post-COVID? Is the investment in CBD office properties going to create white elephants in our various CBD properties? And what needs to be done to maintain relevance? Washington, your head office is in the CBD, but you are a tenant of your shareholder. So I don't think that's a fully rational economic decision. Jeremy, your offices are definitely not in town. Lloyd, your offices are definitely not in town. My offices are definitely not in town. The last time I visited, I was disgruntled. Sorry to take my personal beef out, but by the time we're scurrying around trying to get the swipe to work to get $1, which was changed from $2 last week for parking, and then you clamp me for $500. I think our city fathers are doing themselves a huge disservice in making town quite unattractive. For something to sustain and have value, I believe it needs to offer utility. Put that into the context of You can't run a generator to pull a lift in a 15-story building. You can't supply water at pressure to flush loos on the 12th floor where you've got a power cut and you're running a gen. I think CBDs are generally under pressure, and the move is generally in Harare, moving north. But I'd love to hear the experiences from the panel.
Yeah, thanks, Kura. Could I come in there? I think in
By
the
all
next
means.
5 years, we're going to see some considerable increase in the real US dollar returns on CBD properties. And the reason I think that is the current policies are driving large amounts of turnover underground. So the informal sector will continue to grow as it finds the US dollar a more attractive medium of trade than the Zim dollar. And it needs a place to go. So I suspect there'll be lots of one-office operations working out of the CBD and paying a cash rental on a weekly basis or fortnightly basis over the next 5 years. I don't think the CBD will formalize for a very long time.
Okay. I have a few canaries in the coal mine there. In researching my paper, I was noting the vacancy rates within the listed portfolios. The trend has been positive. The ZPI, they reduced their vacancies by about 6 percentage points. Mashonaland Holdings improved by 3 percentage points. And First Mutual Properties did about 7 percentage points. So from an occupation basis, and I'm taking the listed sector as a proxy for CBD holders, there has been a further uptake of space, notwithstanding the irritations that some of us have described.
Could I just perhaps also give some perspective, because we are interfacing with that dynamic of the CBD either from an occupier's or from an owner's point of view, and the parties are unsettled in both instances. The owner is very concerned that the days of old where 4 or 5 floors would be taken up by a corporate, those days are gone. So who replaces that corporate? Do you redefine the product and make it into shared use? Do you whittle down your rental demands to match the informal trader or the one-man band that's operating, assuming that's where the volume and growth is going to come from? Or do you hibernate the asset and wait for Christmas to come in a couple of years' time, and when the economy is now back on full steam, and we're going to see a resurgence of corporates coming back into the CBD? These are real questions that are dogging your landlords. There are also occupiers who are looking to get out of their current lease arrangements and would seeking a more flexible arrangement, preferably even more variable. So conversations are now taking place around hot desking and shared spaces, the shared spaces dynamic. There's 2 issues that need to come into play as well, which perhaps we haven't spoken about. The local authority is also going to be culpable here. They've got to take responsibility if anything is going to come of this, and they can't hide away from the conversation around what the future of CBD is going to look like and how you zone it or demarcate it, if it's to make any sense. And then lastly, one of the things that we've been tracking in our when we look at our research is what is the impact of the exit of government and utilization of government real estate going to the new precinct that is being developed in the Mount Hampton area. What impact is that going to have on retail? What is the impact is it going to have on office space?
You've given Kafir another webinar for us to look at that and do that. I've got an eye on the clock. I've got 5 minutes here. When you guys were brushing your teeth this morning, what did you tell your madam to say? Hey, I'm doing this webinar seminar, and I've got to tell these guys this particular fact. I've got to let the world know about the Zimbabwean property market. What is that golden nugget? If I can get each of those in a concluding remark from you. I'm going to start with Mr. Moneyman, Washington.
Yeah, so for me, I think from the space that I operate from, the housing sector remains a sweet spot. We view it as a defensive play, given that in terms of demand, it will always be there. We all need accommodation, irrespective of what's happening in the economy and irrespective of natural disasters. At the end of the day, we need a home. So we view housing as a defensive play, and that's our sweet spot.
Thank you very much. Jeremy?
We want to go big. We want to go with a very broad basket of products, and we want to get cracking. This industry creates employment. It ripples across all sectors of the economy. To do so, we need working capital. This country needs liquidity. It needs it fast. And it's going to be a hard decision, because right now I can understand the authorities are exceptionally scared of printing large amounts of money because of the potential effect on inflation. I'm not sure if we have a choice. We need liquidity to be able to trade, and we need vast amounts of it right now. That's for me.
All right, this is just a side conversation. Nobody else can hear us. But what kind of product are you looking at doing? What is your exciting little nuggets that you've got, little schemes that the diaspora, that they're not listening? It's just you and me having this conversation. What's the great, sexy product that you've got out there?
I think for us, our latest one is to sell a stand with a concrete slab, a set of plans, all the services like water and power and roads, but don't build the actual house.
There you go. That speaks to, I think, an elegant affordability model, because you know the Zimbabwean technique. We save, totenga stand. We save, tokanda slab. We slave, we buy some bricks. So in a thin mortgage market as we currently have, the figure I've got from the Center for Affordable Housing or the African Housing Union Finance is that we have something silly like 16,000 registered mortgages in Zimbabwe. That's tiny for a market of this size. I think that product is going to fly. Thank you for that, Jeremy. Lloyd, the pebble in your shoe.
You've lost me there. That's rather complicated English, Kura.
St. George, sorry, honging strong, hong, hong, hong.
But I think coming back to your question about what do we just brushing the teeth. My parting comments are: this is a market that has a strong demand and a desire to provide appropriate supply. And what people, looking at this panel, the ability to find the medium for that to happen. There's a demand for good, properly priced product, and there's a desire and competence in this market to be able to deliver that product. We've done it. We've worked on it together with Jeremy and other clients, and so we continue to see a desire by purchasers in this market, appropriately priced product, and more importantly, they want it done properly. So the presumption that you just build wherever you want, etc. We've been pleasantly surprised by the level of due diligence that is taking place by prospective purchasers locally and externally, and they want things done right. So players have just got to be able to stick to the fundamentals, and I think the future is bright. And then the authorities have to come to the party to make sure that the fundamentals are working.
Okay. I've literally got 16 seconds on my clock here. We will run a little bit over, but so that I've got within the close of the period that time I was allocated. By show of thumbs, gentlemen, Are we going to make it into 2021? Are we bullish, or are we just going to say, Sizobona sometime? 2021, bullish, neutral, bearish?
Bullish.
Jeremy, in this democracy, you've been outvoted by 2-1. I'm going to throw in the chairman's casting vote and say, something's got to give. I really enjoy the diaspora energy and enthusiasm. I see we've had over 100 views listening in on this. The questions, I take questions. I've got a friend with a conveyancing practice in Cape Town. One of their members is literally calling every week, hey, Kura, I've seen this. I've been offered this session in this communal area. Should I buy it? And at great pains, I'm trying to explain to you, no, don't do that. Look for titled land. Get somebody to do a due diligence. Use the safety of the Manokwera attorneys. Go through and see, can you raise finance on it? It's one thing to buy something right now for cash, but if you can qualify for a mortgage, you're winning. It's a great forced saving. It's also building up a credit record for you and a profile that can be of use for you later. So with 1 minute over my allotted time, thank you, Priscilla. Thank you, Kefir. Thank you, Gideon, for the opportunity to share the love that we have for this real estate game. Real estate is not just a passion. It's a job. It's an exciting adventure. And I think we should be at the core of capital formation for the country, where we're taking people's savings, putting it in a mortgage bank, leveraging that up, lending it out, getting developers pull it down, creates more jobs, gives us that fantastic roof over our head that we can raise our families. So I'm handing over control. You don't have to get rid of me like a Malian coup dictator. I'm going to hand over controls to the organizers of the conference. Thank you, gentlemen, for your panel.
Thank you.
Thank you.
Thank you, Kura, and thank you to the panelists. It was a great panel and lots of questions coming through. So we'll also share that with the panel as well post the discussion. There's quite a lot of questions we didn't cover, so I'll send those through, and then we'll share those with the audience as well as the video to this. Once again, obviously, we can continue the discussion at the APR Summit, where we'll have a roundtable around Zimbabwe, and also potentially have it more interactive. So that will be taking place on the 28th to the 28th September to 2nd of October. But once again, thank you to the panel. Thank you to Kura, and we'll be in touch soon. Thank you.
Tinotenda zvikuru.